Hey, it's Mark Van Stein with the Van Stein Partners at RE/MAX Premier Choice. Getting a mortgage when you purchase a new home can be super confusing. There are a handful of different types of loans available, but 78% are made up of three different types: FHA, VA, and conventional financing, which I'll discuss in this video. And the other 20% of buyers are just paying with cash, meaning that they aren't borrowing any money for their purchase. So let's get started with VA loans, which represent less than 5% of all loans out there. VA loans are for people who have served in the armed forces. They are fantastic because they allow a buyer to purchase a property without putting any money down. The rates are usually pretty competitive as well. There are a couple of stipulations that a seller is required to do with a VA loan, and sometimes the appraisals are a little bit tougher. But for a buyer, the VA loan is very, very attractive. FHA loans are backed by the Federal Housing Administration, meaning the government will step in and reimburse the lender if the borrower defaults on the loan. Because they are backed by the government, FHA loans tend to be a little easier to qualify than a conventional loan. They allow for lower income, lower credit scores, and lower debt-to-income ratio. FHA loans are attractive to first-time home buyers who might have steady jobs but just not have that much saved up for a down payment. With an FHA loan, the buyer will have to pay mortgage insurance as part of their monthly payment. This mortgage insurance depends on the amount of the down payment. This extra premium helps to mitigate the risk of the loan and keeps the program solvent without drawing too much tax dollars. Once the equity hits a certain level, that premium usually falls off, or you can have the property refinanced. Lastly is conventional financing, which is the most common. About 65% of buyers use this type of loans. Conventional loans are the most straightforward and considered the safest from a lender's point of view. They are slightly harder to qualify for than an FHA loan and require higher income, better credit scores, and lower debt-to-income ratio. The benefits of a conventional to an FHA loan is a lower rate. The mortgage insurance on a conventional loan is called PMI, or private mortgage insurance. Private mortgage insurance differs from lender to lender. If your down payment is 20% or more, there is no PMI. For anything less than 20% down, it varies from lender to lender. PMI is also determined by your credit score, debt-to-income ratio, and other factors. There are conventional loan options in the market with as little as 3% down now. The advantage of a conventional loan is the PMI will go away once the amount owned is less than 80% of the property's value. So the property is rising in value over time, appreciation can push you over that threshold. These are the three most common types of financing. If you have any questions about loans or the home buying or selling process, give me a call, 614-596-2934.